Hi everyone, welcome to this week's Level 3 session. Today we're going to be looking at Chapter 3, which covers the acquisition and disposal of non-current assets. This is one of the major topics within this unit, tying into one of the first of our year-end adjustments when we start looking at calculating depreciation and how we account for that using the various methods. So let's make a start. So running with the typical format here of looking at a variety of questions that you can expect to see on this topic, looking at what might appear in your assessments and in turn your final exam for this unit. So this is the acquisition and disposal of non-current assets. So first of all, list as many non-current assets you can think of in the space below. You should be able to list at least 6. So I'm going to put in some of the most common ones that you've probably already come across, and maybe a couple of others in there that you might not have just yet. So thinking of the different types of non-current assets. So when we talk about non-current assets, we're looking at items that the business owns, and when we talk about non-current, we mean that more than 12 months. So we expect them to be within the business for quite a long period of time. So typically we'll relate to those bigger items. So for example, we could have vehicles. Okay, so one example of a non-current asset. We could have office equipment. Another common one you've probably seen at this point. Fixtures and fittings. Okay. Also property, plants and equipment. Another example there you've probably looked at. Computer equipment. Okay, so looking at all the IT equipment that's classified as a non-current asset. Land's also an example of a non-current asset. And then a couple of other ones could have trademarks. Okay, and also goodwill. Now, goodwill, you might not have come across just yet, or not in a lot of detail. It's definitely something that will come up probably a bit later on in this unit. But effectively, it's the value of the business based on its reputation. Okay, and it's classed as a non-current asset. But typically, yeah, they're the type of items we can expect. And in the most part, looking at those first few, we are looking at those larger items, things that stay with a business for a long period of time, items that the business owns. So complete the following sentence using the correct detail from the italicized options. So we've got capital expenditure is the term given to expenditure by a business on. And that would be exactly what we're talking about right now, non-current assets. The reason for this is that, and again, we're looking at expenditure on these types of assets should be capitalized. Okay, so capital expenditure is the term given to expenditure by a business on non-current assets. The reason for this is that expenditure on these items, on these types of assets, should be capitalized. This is a different approach to, and the opposite being revenue expenditure, where the full cost of which is written off in the year of purchase. Okay. And we're going to be looking at a few questions here where we actually have to look at what type of expenditure we capitalise and what we can't. Okay, any expenditure which we capitalise, it forms part of the asset's value. Okay, and it's then that we treat that asset, okay, at that full amount over a period of time. And it's when we start looking at things like calculating depreciation, etc. Whereas revenue expenditure, your typical day-to-day transactions, but effectively the full expense is just written off at that time within that year of purchase. Okay. So Pet's aware of the following authorisation levels for capital expenditure. So Managing Director, up to £40,000. Managing Director and Finance Director, over £40,000. Finance Manager, up to £5,000. And Finance Director or Works Director, up to £15,000. Pet's aware are acquiring two new assets. One is a production machine value of £50,000. Okay, so a machine value of £50,000 there. And the other is for some office furniture costing £14,999. Who is authorised to sign off on the production machine? So this is the machine valued at £50,000. So looking at those options above, it's over the 40,000 mark. Therefore, it's going to be the Managing Director and Finance Director. Okay? Because it's over that £40,000 mark. Who is authorised to sign off on the office furniture? Okay, so from the options below, we've got Finance Manager, Finance Director, or Works Director, or Managing Director, Finance Director, or Works Director, and then finally Managing Director and Finance Director. So looking at this costing us just under the £15,000 mark. Okay, so we know that the Finance Director or the Works Director can authorise that. However, so can the Managing Director, because they have an authorisation level up to 40,000. So actually you'd go with the one that showed all three of those rather than option C. Okay, so just look out for that if you've got a little bit of a crossover there. Okay, Excalibur Production purchases a new production machine. Their capital authorisation policy is to capitalise expenditure on non-current assets over £5,000. And we have the costs as follows. So we've got the production machine itself of £80,000. We've got delivery and handling of £1,150. We've got consumables for daily cleaning of £1,250. We've got testing costs after installation of £800. We've got site preparation costs for reinforcement of £2,500, and then a general maintenance contract for £3,000. How much of the above costs can Excalibur Production capitalise? Okay, so when we look at the policy is to capitalise expenditure on non-current assets over £5,000, what we mean by that is that we're specifically looking at the value of the non-current asset being over £5,000. It's easily to get confused with looking at the costs that are there and thinking it's got to be over £5,000 for it to be capitalised. That's not the case. It just relates to the actual cost of the non-current asset. Okay, So all of these costs here you can see are below 5,000, but that doesn't mean we can't capitalise any of those. So I just wanted to clarify that a bit, just because that is something that I have seen people get mixed up with in the past. So the typical costs which can be capitalised tend to include things like delivery and installation, any staff training to use the asset, any testing, so after the asset's been installed, any costs which are incurred through testing, any adjustments or alterations, maybe as a result of that testing, and any legal or professional costs. Okay, so they're all the type of transactions that we can capitalize. Okay, so looking at the information that we've got here, okay, we've got the £80,000, okay, for the production of the machine. Okay, next we can include the delivery and handling for 1,150. We don't include any consumables for daily cleaning. Okay, that's an expense item that cannot be capitalized. That will form part of our revenue expenditure rather than capital expenditure. So we don't do anything with that. However, testing costs, we can capitalize that. So £800 there. Site preparation costs for reinforcement, we can capitalize that as well. So we'll give that a little tick. But the general maintenance contract, that will just be a revenue expense there and can't be capitalized. Therefore, if we add those figures together, we should get an amount of 84,450. Okay, so when we're recording this asset in the accounts, we're not recording it at its cost of 80,000, we're recording it at 84,450, and that will be debited on the relevant asset account. In this case, it would be the production machine account. Okay, so always have a look at the type of transactions which we can capitalize and those that we can't, because that's going to give us our asset at cost amount. Okay, the amount that we can capitalize. So Cosmetic Zone has purchased 2 non-current assets during the year, and here we're told to ignore VAT. A packaging machine for 27,800 on the 1st of May, paid via, and then HP, this is an important one there, that's hire purchase. Okay, just add that there. And then a blending machine for 12,350 on the 1st of August, and that was paid for in cash. You're required to enter both acquisitions in the extract from the non-current asset register, and then to show the double entry which is necessary to record these purchases in the accounts. So this top bit here is the non-current asset register where we're going to record these, and then we've got 3 accounts below which we need to update. So starting with the non-current asset register, okay, we've got 2 rows here that we can enter our information into. So we'll start with the first one, the packaging machine, and we can just put packaging machine in there. If there was a specific product code, then we might put that in there as well, just so it's a better reference as to what the asset is. We've got the date acquired, so we'll put the 1st of May, and then we'll just put XX to represent the current year. And then we have the cost, which is 27,800. Now, at this point, it is important to know that when we're recording the cost, we're not including any VAT at all within this part. Okay, so if we were told that that amount included VAT, then we would have to separate the VAT from that. Okay, so just look out for anything to do with VAT, because that shouldn't be included within your non-current asset register. And then finally, we can put financed by, and we can just put HP for hire purchase. Okay, and that's typically what you'll record within your non-current asset register. You will also look at depreciation and the carrying amount and any disposals, but that's something that we're coming on to shortly. Just not quite looking at that point yet, but you would complete these other columns as well. Next, we've got the blending machine, so we can add that into here as well. The date acquired was the 1st of August, so 1st of the 8th XX, and the amount for 12,350. Okay, and the method being cash. Okay, now we need to record these in the account. So both of these items relate to plant and machinery, and that's the account that they're going to be recorded in. So this is the asset account. So the first one, again, going on the debit side here, okay, we'll go with the amount of 27,800. And what we're going to do is reference the opposite account that that's going to be posted to, which will be the hire purchase account. Okay. And then secondly, we've got on the 1st of August, the blending machine for 12,350, with the opposite account being the bank account, because we paid for that via the bank. Okay, so we've posted on the debit side of the asset account there. Now we're going to post the opposite entries, so credit side of the bank to show that payment. So we'll reference plant and machinery because that's the opposite account for 12,350, and 1st of May, again referencing the other account, plant and machinery, and then for the amount of 27,800. Okay, and that's how we'd record that in the accounts. We're recording the asset value in the asset account, and then decreasing the bank account by the amount paid, and also the hire purchase account there. Okay, so that's the first stage there, really, the acquisition of an asset. Okay, and here just 2 assets bought during the year, and how we record those assets within the account, specifically here within the non-current asset register, and then within the relevant accounts. Next, you are working on the accounts of Games Revolution, who is registered for VAT and has a financial year end of the 31st of December. Games Revolution has a policy of capitalising.
Hi there, and thank you for watching the video. If you're new here and passionate about everything accounting, then don't forget to subscribe and give us a follow. We're proud to deliver the best standard of support to our students. We have bespoke study materials, exclusive AAT unit videos, award-winning tutors, and so much more. Make sure to follow us on our social platforms to stay up to date with what we're working on. Thank you.